Ladies and gentlemen, good day and welcome to the earnings conference call of Dalmia Bharat Limited for the quarter ended 30th September 2023. Please note that this conference call will be for 60 minutes, and for the duration of this conference call, all participant lines will be in the listen-only mode. This conference call is being recorded, and the transcript may be put on the website of the company. After the management discussion, there is an opportunity for you to ask questions. Should anyone need assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone phone. As a reminder, all participant lines will be in the listen-only mode. Before I hand over the conference to the management, I would like to remind you that certain statements made during the course of this call may not be based on historical information or facts and may be forward-looking statements. These statements are based on expectations and projections and may involve a number of risks and uncertainties such that the actual outcome may differ materially from those suggested by such statements. On the call, we have with us Mr. Puneet Dalmia, Managing Director, Dalmia Bharat Limited, Mr. Mahendra Singhi, Managing Director and CEO, Dalmia Cement Bharat Limited, Mr. Dharmender Tuteja, CFO, Dalmia Bharat Limited, Mr. Rajiv Bansal, President and Chief Transformation Officer, and the other management of the company. The earnings release has already been uploaded on the company's website. With this, I will now hand the conference over to Mr. Dalmia for opening remarks. Thank you, and over to you, sir.
Thank you. Good afternoon, everyone. I want to start with wishing all of you and your family members a very happy Navratris. It gives me immense pleasure to welcome all of you to the Q2 financial year 24 earnings call of Dalmia Bharat Limited. After almost a decade of reforms under the leadership of the current government, our country is transitioning from a reform stage to a growth stage. As the GDP of India expands, cement and the building material sector will automatically become a direct beneficiary. The Indian economy is undergoing a large-scale metamorphosis, and our young, ambitious, and massive middle class is already seen to be driving the much-needed consumption story. I'm glad to say that we were one of the first ones to foresee this upcycle in the industry as we started building our capacity ahead of time. In the last 3.5 years, we have added about 17.2 million tons per annum of cement capacity, which is about 65% growth over the financial year 20 cement capacity. With the ongoing cement expansion and the acquisition of JP Associate Cement assets, we are expected to reach 56 million tons by the end of this fiscal. You are already aware that Singhi ji has successfully completed his decade-long tenure as CEO and Managing Director at DCBL. And after 8th December, he will continue with us as a director as well as a strategic advisor to me in our growth and profitable journey which is lying ahead. In the last 10 years, we have witnessed incredible growth and have laid a strong foundation for future growth and profitability. We are now steering our company's transformational journey, Dalmia 2.0. In the past month, I have had the opportunity to engage with most of our leadership team, and together we have started brainstorming on how we should navigate the future. Collectively, we have all reiterated that as before, we have a clear mission to build a scalable, sustainable, predictable, and a consistent organization. Dalmia 2.0. We have categorized our priorities into 4 buckets of growth, financial performance, sustaining trust, and organization building. This includes a deep focus on leadership development and digital transformation. Now coming to the financial performance of our company during H1 of financial year 24. If I break the earnings into revenue and costs, I would like to say that the first half of the year was a bit soft in terms of volume and revenue growth. But on the cost side, I am pleased that our variable cost performance is in line with our expectations. With the softening fuel consumption, with the softening fuel prices to the tune of around $60 on a YOY basis, we have seen that delta flowing into our variable costs, including savings coming in from our sustainability efforts, such as increase in RE power consumption and some positive movement in our other manufacturing KPIs. With this, I would now like to hand over the call to Mr. Singhi for his opening remarks.
Thank you, Punitji. Happy afternoon, friends. Starting with our operating performance during the quarter, we delivered a volume of 6.2 million tons and revenue of 3,149 crore, which translates to a YOY growth of 6.6% and 6% respectively. Like the previous quarter, weakness in south prices persisted, which led to slight drop in the realization for our company. Having said so, the trade sales for our company improved during the quarter to 68%, which was primarily driven by southern region, and that too with a complementing increase in the low carbon cement sale. For the last 3 quarters, our low carbon cement mix has consistently been at a healthy rate of 88%. In fact, last Q2 of last year, it was 83%. For last 5 quarters, our CC ratio has been at 1.71 on an average. We will continue to follow this path in order to enhance our resource efficiency and reduce our carbon footprints further. On the cost side, our raw material cost has increased moderately by 2% YOY to rupees 785 per ton of cement production due to increase in slag and fly ash rate by almost 10 and 5% respectively. This is also somewhat increase in raw material cost on account of higher low carbon cement consumption. However, since this line item also includes purchase of stock in trade goods under the tolling arrangement from JP, you will see that the increase in the financial is a much higher number of 928 rupees a ton. Coming to the power and fuel cost, during the quarter, our fuel cost and power has declined to 26% on a YOY basis to 1,140 rupees per ton of cement production. As Punitji mentioned, our fuel cost declined due to $60 per ton of correction in fuel consumption cost compared to Q2 financial year 23. But as you all know, the fuel prices have inched up again from the recent bottom of about $105 to $110 to now the spot being $130 to $135. Other item which majorly added to our cost efficiency is the increase of renewable energy consumption to 29% from 18% in Q2 FY23. During the quarter, our sales team has been able to bring down reduction in lead distance from 308 km to 277 km YY, but most of it got offset by the levy of season surcharge for the month of July and some one-time railway incentive which were there in Q2 FY23, but not in this quarter. Sequentially, under the freight cost, we saw the benefit of lead distance reduction, the upliftment of the levy of, but at the same time the levy of season surcharge in August, September, and also in the last quarter. There was interregional movement due to plant shutdowns, which was much lower this quarter, and hence a cost reduction from 1,156 rupees a ton to 1,024 rupees QOQ. As a result of all the above, our EBITDA per ton during the quarter improved 46% YOY to 955 rupees a ton from a low figure of 655 rupees a ton in Q2 FY23. Friends, on the expansion side, while Dharmendra will give you the detailed update on capex and cash flow, I would like to update that during the quarter we have commercialized 2 million ton new grinding cement capacity at Satur, Tamil Nadu, and also have debottlenecked our clinker capacity by 0.5 million ton of clinker in Adyalur in Tamil Nadu. Going forward, we have ongoing work for 2.9 million ton cement grinding capacity in the south, which in totality will come to line by March 24, and we are expecting 0.9 million ton cement grinding capacity shortly. 2.4 million ton in northeast by FY26 also would be coming up. In addition to this, the board of Dalmia Cement Bharat Limited has approved the proposal to adding 0.5 million ton of capacity in our Rota cement works in Bihar. We already have a clinker capacity of 1 million ton in the state, which will cater to the increasing grinding capacity. This expansion will help us to improve our volumes in the high contributing state of Bihar. The work with regard to acquisition of JP Cement assets is underway, and we are expecting to complete the acquisition before the end of this financial year. I wish all of you friends happy Navratra as well in advance, happy Dussehra and Diwali. Now, I would like to hand over the call to our CFO, Mr. Dharmendra for key financial updates, and will be happy to answer all your questions in the Q&A and following his remarks.
Thank you, Singh ji. Good afternoon, everyone. Let me quickly give you the key financial updates before we open the floor for question and answers. With regard to the incentives, the accrual during the quarter is rupees 53 crores, while collections during the quarter is rupees 25 crores. For H1 FY24, the total accrual stands at 141 crores and collections at 64 crores. The incentive receivable as on 30th September stands at rupees 785 crores. For FY24, we expect the total accruals to be around 275 to 300 crores. Moving to the fixed costs, our employee cost has increased by rupees 37 crores to rupees 226 crores on a YOY basis, primarily due to the annual increments and increase in number of headcounts owing to addition of new capacities across different locations. The other expenses have, however, remained flattish at rupees 473 crores on a YOY basis. Our depreciation during the quarter has increased by rupees 69 crores on a YOY basis. Of this total increase, rupees 40 crores pertains to certain components of plant and equipment which are being replaced as part of our overall debottlenecking projects. I had mentioned about this during our Q1 earnings call as well, as in that quarter there was an additional depreciation impact of rupees 57 crores. This is a one-off charge, and around rupees 15 crores additional depreciation charge will be taken in the next quarter. On the debt side, our gross debt has increased by 907 crores during the quarter, and the closing debt stands at 5,294 crores as on September 30th. At the same time, the cash and cash equivalents have increased by 615 crores. As a result, the net debt of the company has increased by 292 crores to rupees 1,500 crores. The net debt to EBITDA is 0.59 times as on 30th September. With regard to the capital expenditure, we have spent close to 611 crores during the quarter and rupees 1,517 crores during H1 FY24. With the commercialization of our 2 million cement plant at Satur, Tamil Nadu, our grinding capacity has increased to 43.1 million ton, while our clinker capacity has also increased by 0.5 million ton to 22.2 million ton. Our total budgeted capex spent during the financial year 24 could be around 6,500 crores. Of this, about rupees 37 crores for JP and the balance 3,000 crores for the organic expansion including the expansion projects at Northeast and RCW. The board has declared an interim dividend of rupees 4 per share. With this, I now open the floor for question and answers. Thank you very much.
Thank you very much, sir. We will now begin the question and answer session. Anyone who wishes to ask questions may please press star and 1 on their touchtone telephone. If you wish to withdraw yourself from the question queue, you may press star and 2. Participants are requested to use only handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. We have the first question from the line of Indrajit from CLSA. Please go ahead.
Hi, good morning. Thank you for the opportunity. I have 2 questions. First, Mr. Singhi, thank you so much for your contributions to the sector, not just to the company, and we have all learned a lot from you. I just want to understand the management structure post these changes. So, Mr. Dalmia currently holds the MD position in both the entities. So, would that be the structure, or are we looking to make some more hires, or we will continue with the current structure?
So, can you please repeat the question?
So, as you would be taking over, Mr. Dalmia, as the MD of the operating unit DCBL as well, so would we continue with that structure, or are we looking to hire externally in the MD role?
No. This is going to be the structure. Mr. Singhi is transitioning to me, and he will continue to be associated as a strategic advisor to me in the group. So there will be complete continuity. This is the structure where I will be the MD and CEO of the operating company as well.
Sure. Thank you so much. My second question is on the JPA acquisition. Now, this has been delayed a couple of times. So what is the current status now? Where is it exactly stuck? And how confident are you to complete it within this fiscal year?
So as we told last time also, we have to get approval from several banks, for closing this transaction. And I think there are about 35 banks to process this, and that is taking a little bit longer than what we expected. We are quite confident that we will be able to conclude this transaction by end of this fiscal year.
Sure. Thank you. I have no questions. I'll join back. Thank you.
Thank you. We'll take the next question from the line of Sumangal Nevatia from Kotak Securities. Please go ahead.
Good afternoon, and thanks for the opportunity. First question is on the volumes. If you could share what is the tolling volume in this, the number which we have reported.
3 lakh ton in the quarter.
Okay, understood. So continuing on the volume part, I mean, this looks like the second quarter where we have lost market share. Whereas in the last call, we did share that there's some strategy which did not work out, and we are kind of changing, and from say 2Q onward, we'll kind of recover the losses. So if you could just explain a little bit on this on 3 parts. One, what has gone wrong or what is not working, what is the changes we are doing it, and the third part is from next quarter onwards, can we expect we continuing or going back to old ways of growing at least 1.5 times the market which has been guided in the past quarters?
So I think we already explained in the last earnings call that we took certain pricing decisions in the East, which we think did not work out as we had planned. We have already made corrections, and I think we are going to start seeing results of that from Q4 onwards. We expect that we will continue to grow faster than the industry in the coming years, despite short-term blip. And I think we are very confident about our own marketing and sales strategies. we are also, going to invest in, brand building campaign, and you will see that in the coming quarters.
Okay, so when we say Q4 onwards, that means this year we will continue to kind of underperform, and then maybe from next year we should kind of expect the recovery.
Well, I mean, I spoke, specifically about, the eastern market. In the rest of the markets, we are gaining share. And, like, for example, in Central India, we had literally no presence. Our brand has already started gaining very good acceptance. And I think we will continue to further build on this. It's a market which is quite attractive. In Northeast, we are doing very well. So there are, some pockets where we have to, further. We have already taken steps which will impact sales, and I think you will start seeing that result from Q4 onwards in those markets.
Understood. Just one last clarification. I missed the opening remarks. Is there any one-off element, any write-backs or anything in the cost items?
The current in the current quarter as well as the previous quarter, we have got a build-up of inventory. So that, as per the accounting policies, includes the fixed cost build-up in the inventory, so which will get corrected in the coming 6 months, which may have an impact of about 25 rupees per ton. Besides that, I think the rest of the conditions are normal, and a very small impact could be there of any reversals of provisions that have been significant.
Got it. Thank you, and all the best.
Thank you. We'll take the next question from the line of Amit Murarka from Axis Capital. Please go ahead.
Hi, good afternoon. Thanks for the opportunity. So my first question is on incentives. So in the last 2 quarters, at least, the incentives receivable have been moving up. So is there any specific plant on which you are accruing incentives and receipt is getting delayed?
Yeah, the receipt normally depends on the allocation of the budgets by the concerned state governments. So, but we expect that to catch up in the coming second half. So for the year as a whole, we expect will happen, will also get corrected.
Okay, sure. And freight costs dropped quite sharply this quarter. What's the reason for that? I'm looking at a QOQ basis. Is there any one-time railway freight incentive or anything that came through?
As Singhi explained in his remarks that we have reduced the lead distance to 277 kilometers compared to about 300 plus in the corresponding quarter last year. And there is no railway incentive impact, whereas it was there in the corresponding period last year.
Okay. No, I was looking at per ton. It's dropped 13% QOQ on a per ton basis. So is the lead distance reduction that sharp in this quarter compared to Q1?
One more thing was that in the first quarter there was a busy season surcharge, whereas in the quarter 2 it was only for July. So there is also one of the reasons, and as well there has been reduction in lead distance also.
Okay, sure. And just one last question on capacity utilization. Your utilization seems to be at only 60% currently. Like while we are expanding capacities, the ramp up seems to be a bit slow than what one would have expected to see. Why is it that like the ramp up is taking so much longer?
Like we have explained that in the east now we are ramping up our volumes, and time to come and from Q4 you would see better capacity utilization also, as well as a better market share also. But otherwise there is no problem as such in terms of production. There is no problem in terms of now expanding in everywhere in other regions.
Okay, fine. I'll come back later in this. Thanks.
Thank you. The next question is from the line of Prateek Kumar from Jefferies. Please go ahead.
Yeah, good afternoon. My first question is on your leverage expectations. So if you are able to close the JPA deal in FY24 versus 1,500 crore kind of net debt, we do we expect a net debt to cross like 5,000 crores, or what is that number which we are looking at in terms of net debt?
Yeah, net debt will cross, let's say, the current limit which you are seeing at 1,500. But of course, we still expect net debt to EBITDA to be at least 1:1 in the current year.
Sorry, how much?
Around 1. Around that.
1x.
Yes.
Yes, yes.
So that would mean like net debt to EBITDA, so net debt around maybe something in the range of 3,000 to 4,000 crores, which the peak net debt which you're expecting?
Yes, please.
Okay. And regarding freight cost, is there any element of freight subsidy in Northeast which is also part of cost and which is like changing on a quarter-to-quarter basis, or there is no component there?
No component there. Yes, freight subsidy is not there.
Just last clarification on Northeast, like we have increased stake in we will be increasing stake in Calcom with additional investment. How do we value such kind of investments, like when we are taking stake up from 75% to 95%? Also, is there any update on legal dispute with the promoter there?
See, this is a rights issue. So rights issue is given to all the shareholders in the same proportion. So it is valued at par. So there is no valuation required for this. And secondly, the competition which was decided in our favor, and finally it was struck down by the High Court. So other group has gone to the division bench, and that is still pending. So currently the High Court has decided in our favor.
Okay. In regards to the investment structure, so rights issue, so the other investor would not have thought of participating at all in this. That's why our stake goes up significantly.
Very few investors participated in the rights issue. It was a small participation. So that's why our stake has gone up, because many people did not participate.
Okay, so why would that happen? Because of lack of capital with those people.
I think that question you have to ask them.
Mr. Kumar, I'm sorry to interrupt. I would request you to kindly rejoin the queue, sir.
Sure, thank you.
The participants are waiting. Thank you, sir. We'll take the next question from the line of Satyadeep Jain from Ambit Capital. Please go ahead.
Hi, thank you. There's a couple of questions. First, a clarification question. Considering the volume growth that we've seen for Dalmia in this quarter, is it fair to say that Dalmia did lose market share in some of the markets it operates in? Just a clarification on that.
It may be in just 2 states of East where we might have lost, but otherwise our market share has gone up in South. It has gone up in Northeast, and Central. Definitely we have taken up 3 lakh tons share.
Okay. Secondly, on power and fuel cost, there's obviously moderation in fuel cost this quarter. Where is the fuel cost inventory right now compared to spot, and is it possible to see more fuel cost moderation in the coming quarters?
Yeah, currently the rate is for 1.58, which has gone to the consumption. This is a blended rate, and we expect some marginal reduction in the coming quarter sequentially also, but that could be around 3% or so.
You're saying the consumption cost was about 1.5 this quarter?
1.58 per calorie.
Okay, thank you.
Thank you. The next question is from the line of Jashandeep Singh from Nomura. Please go ahead.
Hello. Hi. Thank you for the opportunity. So I just wanted to ask you that since now we will be adding another 2.9 million tons, so what is the new capex for our total organic expansion? And also if you can provide any, if there has been any update on the FY24 and 25 capex guidance. My first question is this.
First part question, can you repeat?
So what is the total capex for our organic expansion now, from 43.7 million ton to 49.5 million ton?
On this, I'll come back to you. But on the second part of the question, the current fiscal, the guidance is about 6,500 crores for capex, including about 3,500 crores from GFP acquisition.
Okay. On this second question, so we have seen, some it's on pricing. So we have seen strong price hikes in the south and some reversal in east. So if you can give us sense on how the current prices are, that would be great.
So, one, I would say that the east, for us, prices have not slided down. They are holding, and we are able to see about 40 to 50 rupees price increase. And at the same time in south, now, yes, price increase has happened because now demand is improving. So we are quite hopeful that we'll be able to get that benefit also.
Right. And last question, if I may, there was a news article on a legal dispute in the JP Billai plant that JP with sale. So anything that will impact our takeover of that?
The news item which came, I think it pertains to an old development about 2 years back, because there's nothing new development. All this was already known to us when we acquired. So this withdrawal of the claim by sale from NCLT, that is one of the preconditions of the acquisition.
So it won't impact our deal.
Okay. Thank you so much, sir. Thank you.
Thank you. The next question is from the line of Shravan Shah from Dolat Capital. Please go ahead.
Thank you, sir. Sir, I have three questions. So everything is interrelated. So just trying to ask, so on the volume front, so this year FY24, previously we talked about a 15-17% kind of growth for this year. So first up, we are already 9.6%, and we are expecting that volume to improve in the second half. So broadly, what would be the at console level one can think of the volume growth? Second, considering, as you mentioned, the price hike in east, 40 to 50 rupees, and in the south, if you can specify, would be a great. Our channel check says broadly 30 rupees kind of a price hike is already kind of getting implemented. So just trying to connect, if we post GST can think of, at least for us in the third quarter, we should be seeing 15 to 20 rupees kind of per bag. So that is a 300-350 rupees kind of realization increase should be there. And considering the volume increase, though the cost would be marginally declining, is it fair to say that from 956, 955 rupees EBITDA per ton, one can easily see a 1200 to 1300 rupees kind of EBITDA per ton?
First, I must compliment your whole analysis and whole exercise, and your channel is right that yes, prices have gone up in south, and we are quite hopeful that it will continue. And based on this, definitely there will be positive impact on EBITDA on Q3 performance, but at the same time, it wouldn't be right to predict any number.
Okay, but on the volume front, sir, broadly, any broad range where one can think of for this FY24 in terms of the growth for us?
I feel that it will be better than the industry.
Okay, got it. The other thing is in terms of the capex for FY25 would be a 3,500 crore?
Close to be around that level. The firm numbers we'll be able to share maybe in the coming call.
Okay. And sir has mentioned this 2.9 million ton the south that will be starting in the second half. So 0.9 million ton will be coming in the third quarter, and rest Tamil Nadu and AP 2 million ton will come in the fourth quarter?
You're very right.
Okay. And what would be the premium share for this quarter and consumption cost in terms of the fuel? Broadly, it would be a $135 odd for this. KKL we have mentioned, but in terms of the absolute, is it a $135 odd?
So premium product sale is about 21% of trade sale. That is 21%.
Okay.
22%.
Okay.
Yes. Yes.
And the fuel consumption cost for this quarter would be $135 odd.
127 something. 127.
127. Okay. Got it. Is it possible to share the total other operating revenue for this quarter and maybe 1Q FY24? Incentive we have shared, but just trying to get a broader sense. Will it be a 30-40 odd crore kind of extra other operating revenue for this quarter and maybe for 1Q?
No, it wouldn't be like that.
Okay. Thank you and all the best, sir.
Thank you.
Thank you. The next question is from the line of Rajesh Ravi from HDFC Securities. Please go ahead.
Yeah, hi sir. Am I audible?
Yes. Sir, Mr. Ravi, I would request you to kindly use your handset, sir. Your voice is muffled.
Is it better now?
Yes, sir. Please continue.
Sure. Yeah. So first question pertains to the fuel cost which you mentioned 1.58 is for the Q2 in kcal?
Yes.
Oh, great. So there's almost 40.
This quarter, 1.58.
Yeah, this was in second quarter, right?
Yes, please.
And Q3 numbers, are they similar to Q2 or there is some softening which is possible?
Marginal softening you can expect on the consumption side.
Okay. And coming to the demand, sir, first half we have grown by around 10%, and if we exclude the JPA contribution, the volume growth would be close to 7-8%. So for full year, you're saying that you'll look to grow higher than the industry, and first half industry growth would be north of 10%. So, are you looking at a strong volume growth in second half? And if that happens, how would the pricing scenario be there?
Now you see that overall demand in the cement is also growing up in almost all regions, and we are quite hopeful that in Q4 our growth would be quite better. We'll have also the additional capacity in the market also. So we are quite hopeful that we should be able to do better.
Okay. And what was the incentive received in H1? Dharmendra sir mentioned? H1 incentive received?
Total approval was 141 and the receipt was 64 crores.
64 crores.
H1?
64.
No, because Q1 itself.
Yeah, receipt is 64 crores.
Because Q1 you had mentioned around 39 crore received, collected.
Yeah, 25 was received in Q2.
Okay, understood.
Thank you.
Yeah. Thank you, sir. I'll come back. Thank you.
Thank you. The next question is from the line of Aman Agarwal from Equirus Securities. Please go ahead.
Yeah, good afternoon, everyone, and congratulations on good set of numbers, especially on the profitability side. Sir, first question from my end on the eastern market again. So, just wanted to get an update on the end market consumption, since a peer of ours has been highlighting about subdued demand from two major states, mainly West Bengal and Jharkhand. So, is that also impacting our growth in the eastern state?
To some extent, yes.
Okay. So, any kind of update or any kind of expectation, when do you expect a good growth coming in from those markets?
We are hopeful that normally after Puja festival, etc., things will be brighter, and in past also we have seen it, and the same continues our assumption.
Sure, sir. And so secondly, in terms of regional expansion, while we are expanding materially in the eastern and southern region, no further expansion plans are yet planned in the west region, even after Murli having achieved healthy utilization levels for us. So, going on to our next expansion plan, maybe, do we remain open for further expansion into the western market, or maybe via inorganic route in the western market itself?
It's Puneet here. We already have said that we have a ambition to be a pan-India player. And we will look at all markets in terms of demand supply and in terms of market structure. And based on that, we will make our decision to expand in terms of where to expand and when to expand. You will hear about this more in the coming quarters as we firm up our plans.
Understood, sir. So I just asking, mainly because we are not seeing material additions maybe planned in the Western market, so that can shape up well for our company as well. But got your point. Thank you, sir.
Thank you.
Thank you. The next question is from the line of Jyoti Gupta from Nirmal Bang. Please go ahead. I'm sorry to interrupt, Ms. Gupta. Your audio is not clear, ma'am. Your audio is feeble. No, ma'am. I will request you to kindly use your handset if possible.
Okay. Can you hear me now?
Yes,
is it audible?
Yes.
Yeah. So I had two questions. One was on the market share and second on the JP deal, which you've already answered. But my question was on can you give us numbers on region-wise growth rates for Dalmia? I know we have lost market share in Bihar. What is the other state we have lost market share? Correct me if I'm wrong. And YOY, regional growth YOY basis for the second quarter?
We do not share market share region-wise and state-wise. Thank you.
No, I said, okay, you don't share, but what are the two states that we have lost market share? Any visibility on that?
Little bit in West Bengal and Bihar, not Bihar.
Correct. Okay, correct. So Bihar and West Bengal. That's it. Thank you so much.
Thank you.
Thank you. We'll take the next question from the line of Saket Kapoor from Kapoor Company. Please go ahead. Mr. Kapoor, I have unmuted your line. Kindly proceed with your question.
Yes, thank you. Can you hear me now?
Yes, sir.
আপনি যে ব্যক্তির সঙ্গে কথা বলছেন তিনি আপনার কলটি হোল্ডে রেখেছেন।
As the current has put the conference on hold, we'll move on to the next question, which is from the line of Amit Murarka from Axis Capital. Please go ahead.
Yeah, hi. Thanks for the follow-up. Continuing with my earlier question, given that capacity utilization is only 60%, and I believe there was an interim target of 75 million tons by FY27, can we expect a rethink on that expansion plan now, given that the current capacity itself are taking time to ramp up?
We take these decisions based on our long-term conviction about growth in the Indian market. And I don't think, a few quarters of lower utilization has changed our, fundamental conviction about the, Indian opportunity in this decade. So I do not think that we are going to make long-term decisions based on a couple of quarters, of view. So no, this is not going to impact our thought process.
Sure. Thanks for clarifying that. And also, any update on the east mining land? I believe you were adding on to the surface rights by acquiring more land over there.
Presently, we have sufficient limestone deposit also, as well as the process which we started for acquiring additional surface rights. That's going on.
Okay, thanks. That's all.
Thank you. The next question is from the line of Saket Kapoor from Kapoor Company. Please go ahead.
Yeah, namaskar, sir. Hello, you can hear me?
Yes.
Yes, sir. Firstly, about this other income component, it's regarding the dividend received from your subsidiary. So if you could explain the nature, which subsidiary we have received this dividend?
You're talking about receipt of dividend in Dalmia Bharat Limited?
Yeah, the other income component. I needed the granular details for other income component of 85 crore for the quarter.
This is at the Concall level. So Concall level includes dividend from Dalmia Bharat Sugar and also the treasury income on our treasury investments, and including whatever NCDs are recoverable from Chipco store as well as Sarvapriya, so the interest on that.
Okay. And the major component from Dalmia Sugar dividend income?
No, that is a small component. That's a very small component.
Sir, on the cost of material consumed, Q1Q we have seen an increase. So what explains this 3% increase on Q1Q and for the first half at 5%?
There are two components. One is there have been higher rates of slag and fly ash, but major increases because of the increase of the blended percentage also.
Net percentage. Didn't get you, sir. Come again. Hello.
Yes, please. Sorry. Can you repeat?
Sir, I missed your point, sir. You said it's about the slag impact and other.
The increase of the slag rate and fly ash rate.
Okay. And so going ahead, this is going to be consistent. How are the slag prices currently trending?
So they remain volatile, but yes, we expect it to be around similar level.
Similar level only. Okay. And sir, we are expanding majorly in the southern part, but the southern markets have always been lackluster historically also. So what gives us the confidence that here the markets are going to improve substantially and thereby our expansion would commensurate going ahead, capacity expansion?
I think most of our expansion is in Tamil Nadu. It's a deficit market in terms of demand supply. And I think we have a very strong presence in that market. So I think we are very confident that this expansion is, very healthy and going to give us good returns. There's some expansion in Karnataka, in Belgaum, which is also, for North Karnataka and the Western Maharashtra market. I think there is a big opportunity as markets are growing and economies are growing. So I think, the challenge in the southern market is Telangana and North Andhra Pradesh. And that's not a place where we are investing. So we are investing in that part of the market which has opportunity and which intersects with our strengths.
Sir, for the southern market, especially for Tamil Nadu.
Sorry to interrupt, Mr. Kapoor. I will request you to kindly rejoin the queue, sir. There are several other participants who are waiting for their turn. Thank you. We'll take the next question from the line of Rashi Chopra from Citigroup. Please go ahead.
Thank you. You would mention that you're focusing on a branding exercise. So with that, what kind of volumes are you targeting, one for FY24 and also subsequently for FY25?
I think we will share with you, this guidance, once we are ready. I think right now it suffices to say that we are looking at increasing our utilization and growing faster than the industry.
All right. On the pricing aspect, what is the quantum of the price in the east? You mentioned 40 to 50. South is about 30 to 40. Is that correct?
In south, the trade is on 30 rupees at the moment.
Okay. And in your opinion, in both the regions, how sustainable are the increases given that they've come after a while? And
wait and watch.
Let us say it's a wait and watch only. But
okay. Also, what was the lead distance during this quarter?
277.
Thank you.
Thank you. The next question is from the line of Vishal Biraiya from Bandhan AMC. Please go ahead.
Could you give the perspective of the trade demand and the non-trade demand? How is the infra and real estate panning out across east and south? And also, how is your profitability between trade and non-trade moving?
I would say that our trade volume has grown, and more particularly in south, we have been able to grow to 68%. And profitability definitely is always a bit lower in institutional sales. That's what I can explain to you.
So, how much lower would that be? What would be the current difference between trade and non-trade for you?
It varies from place to place, and those numbers cannot be shared, please.
Some qualitative aspects.
Thank you.
Thank you. We'll take the next question from the line of Sanjay Nandi from VT Capital. Please go ahead.
Yeah, thank you for the opportunity, sir. Sir, can you please throw some colors on our investments in this RHI Magnesita, like what we are thinking as of now?
We have no investment in RHI Magnesita in Dalmia Bharat Limited.
But we are holding that significant stake in that company, right, sir?
It's not a part of this company.
So can you please throw any light, sir, on our director business? What is the outlook and what we are thinking on that?
We had divested the DBRL shares. So currently our economic stake in RHI is 0. So DBRL holds the economic stake in RHI.
Yeah, from a company perspective, I'm asking you that, sir. What is your overall view from the top management perspective?
Let us not discuss in DBL call.
Sure. Thank you, sir.
Thank you. The next question is from the line of Amish Thakkar from Singular Gulf India Advisor Private Limited. Please go ahead.
Hey, hi. Congratulations on a great set of numbers to both Mr. Dalmia and Mr. Sanghi. I have a couple of questions for Mr. Dalmia. Just want to understand, Dalmia has always been a cost leader in all the micro markets that they operate in, and there are multiple factors that drive that. So when you think about, from your medium-term perspective, the next 2 to 3 years to your long-term, guidance that you've given of being 100% renewable, where you're 29% today. Similarly, for lead distances and energy consumption per ton of cement and power cost, electricity cost per unit of electricity. Any medium and long-term targets that you're working with, given that your blending ratios and rates seem to be capped out?
So I don't, think we can, share any target right now on this call. But all I can say is that, our renewable mix will expand in the total mix. Secondly, I think, we have won some, coal mines in auctions. And I think our fuel cost as those mines come into production will become less volatile. Currently, we are, very exposed to, imports and the rupee-dollar exchange rate. As these mines come into production, our, coal prices will go down. Will go down in the short term, given where we are today, but it will become less volatile for sure. And I think, finally, I think we are just looking at how to optimize our, logistics cost and the segment mix. And, over the long term, there are multiple levers on these, costs which we will, work upon. So I think there is, still, juice left in becoming more efficient as we build scale. But I'm unable to give any guidance on what those numbers, could be on this call.
And can you explain the drivers behind the reduction in lead distance? Is it the more, digitizing the supply chain, any other initiatives that are driving, this 10% reduction in lead distance this quarter, and how sustainable this is?
I think some of the markets which are closer to our plants, our service levels, are much higher, and our sharp focus on those markets, has led to this reduction in lead distance. So, we are continuing to, think about, which markets are, core to us in terms of where we have a competitive advantage, in which micro markets. And I think in those markets, we will, just plan to increase our share.
And lastly, on the share of DSP in your trade mix, where your realizations are significantly higher, and it's at 30% in East, 20% in East, and 10% in Northeast. So, any guidance going forward in terms of share of premium cement in your overall trade mix?
I think we don't give breakups of, our premium product mix by region. But, I think, again, as a part of our strategy, we want to increase our premium product mix. And I think our branding exercise, will be a step in this direction. But this is a long-term, plan. So this is not something which will give us results quarter after quarter. But over the next 2 to 3 years, I feel that, it should help us in increasing our premium cement mix, in a reasonably significantly.
And one final question from my side. Is green fuel price competitive with traditional fuels, or is this again a long-term investment that you're making?
I think it just helps us, become more environmentally friendly, because it is we are recycling waste from other industries. And I think second, it gives us a hedge against volatility in fuel price. So I think from both a eco-friendly perspective and a cost perspective, it is beneficial. But again, as I said, that markets change from time to time, and we want to create the maximum flexibility in our process that we can use the most cost-efficient and the most eco-friendly fuel, in times to come. So we want our process to be so flexible that it can use all kinds of fuel, and that gives us the best negotiation power, and that gives us the maximum hedge against cost volatility.
Okay, thank you so much, and all the best for your tenure as MD and CEO.
Thank you very much.
Thank you. The next question is from the line of Raghav Maheshwari from Asian Market Securities. Please go ahead.
Sir, what is our current product mix between the PPC, OPC, PSC and PCC at a company level? Because this time in the annual report, we have not given this number.
I think we have already shared that our blended cement mix is 88%. So I think, and we've also said that over, the next few years, we want to move to a even higher percentage and hopefully 100% low carbon cement. So I think that is the guidance that we can give as of now.
Sir, as a product mix, you will not give for the future prospects between the products PPC and PCC and PSC? Because it is a blended level, so that's why.
So Raghav, we have given this number previously. On an annual basis, you will get the number from us. But on a quarter-on-quarter, it's not possible to share it over the call every time.
Okay. And sir, this is the time this time is the lead distance. It's a 277 kilometer. It's something which we are doing for our market reorganization like thing, or this is the sustainable number for the future also? Or this time, because of the low volume and the seasonality, this number is.
I think we'll have to manage this dynamically, and when the volume growth is low, we try to optimize our costs, and when volume growth is higher, then we may have to choose longer lead markets also. So I don't think that this should be taken as a permanent structural reduction, but all I can say is that we will optimize our profitability, and we look at which are the core markets where we want to really compete, and at the same time we want to look at volume growth as well. But if you want to look at our 5-year average, the 5-year average lead distance is somewhere between 280 to 290 kilometers.
Got it, sir. Sir, last one question from my side. What's our thought process behind remaining stake of the Dalmia refactories and the IEX? What's the time frame we are looking to divest?
The DBRL stake is already divested. Whatever proceeds are to come, they'll come as per the schedule, partly in now December and partly September next year. And IEX also will get disposed of. It's already been considered as a non-core investment. Of course, that timelines we cannot share, but it should be soon.
Got it. Thank you.
Thank you. Ladies and gentlemen, that was the last question for today. I would now like to hand the conference over to Mr. Puneet Dalmia for closing comments. Over to you, sir.
Once again, I thank all of you for joining this call and your interest in Dalmia Bharat Limited. I wish you and your families a very happy Dussehra and a happy Diwali in advance, and look forward to continuing our interaction in the next year. Once again, thank you for your interest.
Thank you very much, sir. Thank you, members of the management. Ladies and gentlemen, on behalf of Dalmia Bharat Limited, that concludes this conference. We thank you for joining us, and you may now disconnect your lines. Thank you.